Yeah, this is Matt Price with Guild Mortgage. We're your local lender. We do everything from zero down on up to jumbo. We're always here for you. We work days, nights, and weekends, working hard to get homeowners into homes in this crazy market. In Washington State, Guild Mortgage is a national lender. We're all over the United States, based in San Diego. I've been with Guild since 2009. Love the company, so been in the business about 20 years or so. Basically, we don't have bank account. You don't have checking and savings. We just do home loans strictly from zero down on up to jumbo. So,
why is it important for someone seeking a home loan to choose a private lender over a standard commercial bank?
I would say both are good options. Private lender is going to be more available probably on the weekends and evenings. If you go to a big box bank like Chase, Wells Fargo, Bank of America, they're all good banks. They got good rates. As a private lender, we're Guild Mortgage, we're going to be more available on the weekends and evenings and after hours rather than just 9 to 5. So we're there in the trenches on the weekends with clients, especially in this market.
Is it too late to apply with a private lender if they have already applied with a bank?
Nope. You can apply with a private lender and go apply with the bank after, or you can apply with a bank, big bank like Wells Fargo, Chase first, and go apply with a company like Guild. Doesn't matter. The key is to do it within the same period of time for the credit pulls. So you're not pulling credit outside of that 30 days. You're doing it all at once. So you don't have credit dings. Once you start pulling credit too far out, it can start affecting your score.
So let's say when you first pull your credit, you have 90 days to check with other lenders before it counts as another hard inquiry on your credit, correct?
That's what they say. I'm not positive on the 90-day rule. I would say do it in 30 to be safe, but it could be 90. I think there's so many different opinions on that, but just do it within the first 30 days to be safe.
And this is to ensure that you can shop around and get the best rate.
Absolutely.
What is the first-time homebuyer program?
First-time homebuyer program is a program that has zero down or down payment assistance for closing costs. And it's actually those that haven't owned a home in the last 3 years are considered first-time homebuyers. So we have zero down or down payment assistance, or money toward closing costs for that program. And then there's also another program that you don't have to be a first-time buyer, and you can still get the down payment assistance for closing costs or down payment.
Oh, so it's not really specifically just for first-time home buyers. It's pretty wide.
There is. They opened it up. Depending on the program, there's the home opportunity, which is first-time home buyers only. That's a little better rate. And then there's the home advantage, which is going to have a higher rate, and that's open to everybody. So depending on the client, we're going to pick what program is going to be best for them.
What is a seller buy down, and how does it benefit the buyer?
Well, seller buy down, you can do a permanent buy down or a 1 and 2 year, 3 year buy down. There's two different types there. Permanent buy down is where the seller buys the rate down at closing with seller credits toward rate buy down, and you can buy that rate down permanently for 30 years. That's a little more expensive than like a temporary buy down, which is a 1, 2, and 3 year, where there's a certain portion that you can ask the seller to pay to buy down your rate, say from 6.5 to 5.5 the first year. So 1 year is going to be, it might, cost you 1 point to get it down to 5.5 from 6.5 the first year. And then second year, it goes to 6.5. So first year, 5.5, second year, 6.5. 2 year would be 4.5 first year, 5.5 second year, third year, now you're at your final rate of 6.5. But it's not an ARM, it's a fixed rate. So after 3 years, on that third year, it goes to 6.5, then it's fixed for 30 years.
So if you were projecting that the rates were going to go down in the next 3 years, the temporary buy down could be a good route.
Absolutely, yeah.
And therefore saving you more money and paying less interest in a shorter amount of time.
Yeah, so the reason they would do a temporary buy down, say 1 year or 2 year, they expect rates to come down next year. That's what they're thinking. So you do a 1 year buy down, let's say you're buying now. It's down for the next 12 months. And then May of next year, you could refinance potentially down to that lower rate. It just buys you time at that lower rate until you can refinance out of it to a lower rate.
How can we help someone who wants to buy a home but likely won't be ready to buy in the next year?
Well, it depends on what their limitations are. Is it credit? Is it income? Maybe they've started a job and they're going to make more money down the road. So basically, for a client, they'll call me up and they'll say, hey, I'm not ready now. I need to know what I need to do to get ready. So it's perfect. It's free to find out. We pull credit. We make sure their credit's where it needs to be. And if it's not, we get a game plan to move their credit up. If depending on what kind of program they're looking for. I mean, we could do loans with down payment all the way down to 580, but that's tough to get loans at that. So we'll find out where they're coming from, what they have for down payment, what kind of loan they need, and then pull credit and get them dialed in based on where their income is now, where they think their income will be. We'll give them an idea. We can even get them an idea now based on what their income is going to be in a year from now, what they qualify for, similar price range, based on what we see right now. Even if their credit's low, we know we can move up their credit. We have credit repair guys that can help. We also do run simulators to figure out what to do to move the scores up. Maybe they're just starting a job and they've been out of work for a while. They need to wait 6 months. So we say, hey, you got to be on the job 6 months, but let's look at it now to see where we're at. We can give you a ballpark idea of your price range right now, even though you're waiting 6 months or a year.
How long will you nurture a client and help them reach their goal of being a homeowner?
Well, I mean, we can nurture them for years. We collect their information, get them dialed in, put them on a game plan, and then we can check in with them every 6 months. They can call us anytime they have questions. If it's credit work or I have a lot of people call me on credit. We're working on credit for 6 months to a year. I've had people that came back after 2 years. We worked on credit for some people for 2 years. Finally get them in a position to buy. And they bought a house. But sometimes it takes a while. But, we'll work with them however long it takes. As far as being in debt prior to buying, so there's a couple of things. First of all, when you're getting pre-approved, the worst thing you can do is buy a car right before you get pre-approved, right before we pull credit. Because that car loan, an average car loan at $400,000 can drop your buying power by about 80 grand in buying power. So a car loan, it's devastating for buying power. If you can not have car loans are the key to being able to buy. You can have a client that makes more money, a lot more money than one client, and has 2 car loans. He qualifies for less than a guy who makes less, has no car loans. So I would recommend, not having car loans for one. But if you do have a car loan and you pay it off right before you apply, your score could drop, right? So a lot of people will come to me and say, hey, I just paid off my car. I want to apply for a mortgage now. Well, that's great. So I pull credit and the score's low. And they said, oh my gosh, why is my score so low? Well, that's because you paid off your car. So once you pay off a car, you lose all that credit history on that car, what you paid. So if somebody has the money in their bank to pay off a car, I'd rather pull credit before they pay off the car, and so it doesn't drop. And then after we pull it, they can pay off the car. That's fine. Or we can pay it off at closing if they've got the money.
What are some of the things that could affect their pre-qualification when they actually put in an offer for a home?
Well, I would say don't charge up your credit cards because now when you pull credit, it's good for 4 months. So you have to buy a house within that 4-month period. What you don't want, if you're racking up credit cards, your scores can drop a lot. They can go down 30, 60, 90 points. Your credit report's good for 4 months. If we have to re-pull it prior to closing and they've maxed out their balances, it could really hurt their approval. And possibly they could lose the house by having debt ratios over a certain amount. So when you go apply, after you pull credit, you don't want to do any crazy purchases. You want to keep credit cards at a minimum. Don't go buy anything on credit. Just, keep it how it was when we pulled the credit.
What is a home equity loan? How does it work? And how does it affect the current mortgage?
So a home equity loan or a HELOC is a second mortgage, basically. So you leave the first mortgage alone. A lot of people get home equity loans for cash out. You get a second mortgage to work on the house, do fixes, pay off bills, things like that. But it's just another mortgage outside of the first in second position. And so a lot of people might use them instead of pulling cash out on the first mortgage, they might do a second because their first mortgage rate might be better than what market rate is now. So you leave your first alone because you don't want to refinance it and go. A lot of people are at 3% right now. They want to pull cash out. I get that call a lot. People want to pull cash out of their house, work on their house. They're at 3%. Well, they're going to go to 6. So I would recommend keeping your first mortgage loan, getting a HELOC or home equity loan at a higher rate rather than taking your whole mortgage and redoing it at a higher rate. So,
Could a homeowner use their home equity to buy another property, rent it out, and generate a long-term passive income asset?
absolutely. Yep. So, a lot of people will use the home equity loan to buy another property. And so that happens a lot. Rather than they can pull from their 401k, it's a loan from a 401k. If you don't have money in the bank, you just get a HELOC on your current house, 50 grand, 100 grand, whatever you need. And then you use that for down payment on the next place, right? Because you're just moving money from one asset to another. This one gained 200,000 in equity. Now you want to buy another house. You're going to grab 50 grand of that equity, move it in a HELOC over to this one with a down payment, and then you buy that one. Then you can rent this one out, right? And now you can just buy. And so that's how people buy a lot of homes.
Yeah, because then they're just paying off the existing loan, and then they're using the equity to keep buying more properties.
Absolutely. And the renters, when they go to buy the other property, they're going to have the renters paying the mortgage. So you got to say, okay, well, let's say you're renting it out at $2,400 a month, or you can rent it out. So you want to go buy another property. This one to rent for $2,400 a month or $3 grand a month. Pretty around here, houses $3 grand a month. And your home equity loan that you use for down payment is $250 a month, plus your mortgage, and you might owe maybe your payment's $2,500 a month, and then your home equity loan is $225 a month. So now you're at $2,750 a month, but you can rent it out for $3 grand. Now you rent it out for $3 grand, it's paying the mortgage, and you just put down payment on the next house, and now you're going to live in that for a couple of years, and you can do the same thing, and you just do it over and over and create your monopoly. A lot of people don't think they can do that, but I mean, you just get a rental agreement, proof of deposit in place prior to closing, and that's used to offset the payment so you can go buy a new place. That's how people buy homes that don't make a lot of money. The new guy just pays your payment, offset that payment, and you can go. I had a guy.
Oh, you mean so that you're talking about the rental income?
Well, you need the rental income to offset the payment so you can go buy another house, right? Because typically you can't qualify for 2 mortgages, but that rental income is going to help you qualify for the next one. So a lot of times it's hard to qualify. A lot of people, you have their current home, right? And they want to buy another house, but they're like, wow, how am I going to qualify for 2 homes? You get a home equity line of credit for down payment on the next place, and then you're going to have your first mortgage plus the HELOC payment, and then you're going to, prior to closing on the next home, we're going to have a rental agreement in place on the current house that you're exiting, and that's going to help offset that payment so you can qualify for the next house. So you don't have to qualify for 2 homes because that rental income is going to help cover that mortgage as long as you have a rental agreement in place prior to closing with proof of deposit from the renter and you're renting it out. Now that payment is offset. Now you qualify for the next house.
Are you familiar with the rent-to-own program?
There's a couple ways they can do it. You can do a lease option to buy down the road, or you do a lease. You do a lease with an option to buy built into the lease. Say it's 2 years. So that there's a couple. You got to be careful because there's a couple different ways they can get you. A lease option is you're leasing it, and then now you're leasing it because your credit might be bad. So that seller will let you lease it for 2 years with the option to buy it in 2 years. Right? That's the lease option. And then there's the private contract where you can get into contract on a house with a seller and he puts you on title and you're actually paying him. He's the bank. That's seller financing. And then you're on title. So it's your house. And then you're paying him. And if you default, he takes the house back. And then a rent to own is, I think rent to own is really similar to lease option. Like, you're signing a lease with an option to buy it down the road. And a lot of sellers like that. A reason why would a seller like a lease option? Well, the renter is going to treat that house nice. And so what they're going to do is they're going to lease it to the renter, and he's going to ensure, the seller ensures that, look, this guy's not going to trash my house because he's going to buy it in 2 years. What many times the sellers do is they'll do lease options all the time. Or they want a person renting their house to think that they're going to buy it in 2 years. But that buyer might never fix their credit and they'll never buy it. But at least they treat it right. And they know going in that the buyer will never buy this house. It's just never going to happen. But it keeps them from trashing the place because they always have that carrot hanging that they think that, you know, they're going to buy the house.
What is a reverse mortgage?
So a reverse mortgage is a mortgage where you're at a retirement age, maybe your income's low, and you've got a mortgage and you can't afford the payment, but you want to stay in your house without selling it. So in essence, you go to the bank and they'll reverse the mortgage. Instead of you paying them, they'll pay you at a percentage rate. So every month you'll get a check for $1,200 to $1,500, and instead of you paying them $1,200 or $1,500, right? And so every month they charge interest, and your balance goes up every month depending on how much money you qualified. You got to still qualify, but they got to have enough equity in there to do it. That's the key to reverse mortgage. So, and sometimes you can get a lump sum on a reverse mortgage, like they'll give you $100,000 up front, and then you just live off that for a while.
Especially if your equity is going up a lot.
Oh yeah.
It sort of offsets it.
Absolutely.
Yeah.
Yep. This is Matt Price with Guild Mortgage. We hope this video is useful and beneficial and answers a lot of your questions. Thanks so much.